Hi and welcome to Swissquote's Daily Market Talk. It's Tuesday, February 17th. US and most Asian markets were closed on Monday, so trading in Europe was rather subdued. Though yields here follow the US peers lower and defense and bank stocks outperformed on deteriorating relations with the United States. Meanwhile, risk appetite for technology stocks remains quite fragile this Tuesday morning on the good and old leverage investment worries. And activity in credit derivatives warns that investors are now out and hedging what was once considered negligible credit risk instead of chasing a dip. So, we will talk about all that and more, but before we do, please keep in mind that opinions are my own and this is not financial advice.
This show is brought to you by Swissquote.
So with the US and many Asian markets closed, the first trading session of this week was rather calm here in Europe. The European yields were pushed lower, influenced by the downside pressure on the US peers, following a softer than expected CPI report on Friday last week. So a benchmark for the European bond yields retreated to the lowest level since the beginning of last December. The STOXX 600 index added a meager 0.13% yesterday. The defense stocks outperformed their peers unsurprisingly, following a sour meeting among the Western allies during last weekend, to which the US didn't even bother sending its highest level officials, and where Germany and France simply started talking about nuclear deterrence to tell where things are going. Elsewhere, we've observed a slight divergence among regions as well. The German DAX fell, pressured down by the technology stocks, while CAC 40 eked out a small gain yesterday, helped by inflows into the European defense stocks. European banks, on the other hand, across the region raved on the news that Europeans are now looking to strengthen Euro's global status as a reserve currency, but also to strengthen its position in international transactions. The continent now wants to offer euro liquidity to peers around the world in times of crisis, and this is a huge promotion of the single currency, mind you. This to me is one of the strongest responses from the Europeans to the US, a sign that Europe is finally waking up, maybe. Hallelujah. Now, later would be great news for the euro, obviously. It would increase the euro's demand and its valuation, especially given that the euro area offers policy stability and visibility to investors when the Federal Reserve is fighting for its own credibility. Wrong policies in the US, both regarding trade, political, and geopolitical matters, are looming risk for the US inflation. And inflation ultimately means outright loss of value for a currency, a thing that you don't want when you hold a currency as a reserve currency. And of course, if the euro circulates more around the world, the companies will also be tempted to issue debt in euros. Euro-denominated transactions would reduce the FX risk for the European companies. Think of the impact of the US dollar on global inflation and FX risk that people need to hedge. But all that would disappear. So there will be a lot of positives in this context. There are some points to be careful with though. A global currency means a strong currency as well, and strong currency is not necessarily great news for exporters, for example. It makes their products more expensive in foreign markets and may impact their demand. But alas, everything comes with a price rise, so this is why the French said that they back the plan of stronger global euro, but they would like a better understanding of the risks and economic impact. But in fine, we all know that the US loss will become someone else's game. Many regions will be fighting for that prestigious status, including China, in the coming months and years, in my opinion. In the short run, however, the euro traders didn't blink. The euro continued giving back the early month gains against a broadly stronger US dollar. But the US dollar is softer again this morning in Asia as the dollar yen is retracing yesterday's gains. The yen actually strengthens on thinking that the morose growth figures that we saw from Japan yesterday won't change the Bank of Japan's normalization plans, as the Bank of Japan wants inflation down, and the price component of yesterday's GDP report was the only upside surprise there. Now today, the US will return from their long weekend into the arms of investors no longer hungry for risk, especially in technology. The Nikkei is down this morning despite a notable fall in Japanese yield. On rising bet stats, Sanae Takaichi will somehow keep countries' finances healthy enough while splashing money on the Japanese economy. I'm quite curious to see how she's going to do that magic, but it looks like the markets are with her today. SoftBank, on the other hand, which is a gauge of big technology appetite, is down by more than 5.5% at the time I'm talking here this morning, while Nasdaq futures are leading losses among major US peers, hinting that appetite for technology is not strong this morning, far from that. And in the absence of major catalyzers, or with the major catalyzer remaining unchanged, well, there is little reason for this bearish momentum or the lack of appetite for big tech to reverse. On the contrary, the increasingly leveraged AI spending story is developing further right now. Listen to this. I love this line from Bloomberg News, which reads, "Debt investors are worried that the biggest technology companies will keep borrowing until it hurts in the battle to develop the most powerful artificial intelligence. They will keep borrowing until it hurts them." Hence the investors as well. And they might be right, because big tech is going through a major financial transformation today. These companies, think of Meta, Google, and Microsoft, for example, used to have solid balance sheets for years and a lot of free cash in hand, thanks to a business model that used to be relatively capital light. But alas, AI is very capital hungry. It requires building complex and advanced data centers using powerful and newest generation chips. The investments should be done before these companies start making money out of them. And well, you don't build a data center overnight. So the moment between you spend your capital and you cash in, the return is around 12 to 18 months. It could be longer. So you need to burn cash during this period of time. This is what the big technology has been doing over the past 3 years, burning cash. The return, on the other hand, is not there or not strong enough for many of them, but the spending plans keep growing for each of them still. So that means, in the context of pressured cash levels, a part of spending will be on debt. And adding debt to a balance sheet increases solvency risks and changes risk profile of a company. Happily, markets always find a solution to a problem like this, and one way to hedge against rising credit risk for a company is to buy credit derivatives. CDS being one of the most popular instruments. Those are the credit default swaps that are traded on the markets on, well, single companies or whole sectors. Now, we all know that Oracle CDS, for example, became one of the barometers of the AI debt since last year. And well, it's because one, Oracle is highly indebted, and two, CDS tied to a single technology company like Google or Meta didn't necessarily exist or had very low liquidity a year ago. CDS tied to Oracle, Amazon, and tiny amount for Microsoft were up and running still, but there were no such products, for example, tied to others like Meta or Google. And that's because nobody doubted the strength of their business, nobody doubted the strength of their balance sheet, nobody doubted their ability to service their debt, and nobody needed and nobody would pay for such a product. But since the middle of last year, CDS tied to big spenders are not only popping, but also growing in volume, reflecting the growing fears and the growing need to hedge against rising big technology credit risk. Now, we are not at a catastrophic level, but investors are willing to hedge. So we see that to Oracle, Microsoft, and Amazon are added the CDS tied to Meta, Alphabet, and even Nvidia. And that is not necessarily an excellent sign in the short run, I'm telling you, because it means that all indicators now point out waning appetite for big technology due to the huge AI spending and rising debt levels, and appetite will hardly be restored before maybe a decent correction in these big technology stocks valuations. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.